In the cutthroat world of high finance, where self-interest reigns supreme, one institution has not only survived, but thrived for more than 100 years, cementing its legacy as the embodiment of Wall Street itself. Revered by some and reviled by others, this firm has earned its reputation as the undisputed master of risk, where every victory for Goldman Sachs often means defeat for its rivals. The story begins in 1886 with Marcus Goldman, a Jewish immigrant who revolutionized finance by creating what we now know as commercial paper, buying short-term debts at a discount and reselling them to investors at a profit. Unlike traditional banks, Goldman embraced higher risk, higher reward financial maneuvers from the start, a harbinger of the firm's future. Within just 10 years, his firm was trading an astounding $30 million annually. As competition intensified, Goldman Sachs found a new frontier in the world of initial public offerings, IPOs, creating a path that would ultimately lead them to dominate global finance. The exuberant dance of the Roaring Twenties crashed to a jarring halt on Black Tuesday, October 29, 1929. The ensuing financial earthquake sent shockwaves through the nation, leaving unprecedented economic devastation. Half of America's workforce became unemployed, marriage rates plummeted, and the national suicide rate surged by a staggering 40%. This cataclysm nearly consumed Goldman Sachs. Hundreds of millions of dollars vanished into thin air, leaving the firm nursing a substantial $13 million loss. Investment trusts crumbled, dragging countless investors and established banks into the vortex of financial ruin. Yet, against this backdrop of widespread collapse, Goldman Sachs managed to cling to survival, a testament to the resilience and influence of one remarkable individual, Sidney Weinberg. The 1950s witnessed a watershed moment. Goldman Sachs, despite the Ford founder's well-documented anti-Semitic sentiments, was granted the privilege of underwriting the IPO of the Ford Motor Company. This symbolized not just a financial transaction, but a significant evolution on Wall Street, a crack in the old guard's prejudices. As substantial profits accrued, a relatively modest trading division was quietly flourishing under the astute leadership of a man who would soon become a legend, Gustav Levy. As the distinguished era of Sidney Weinberg's leadership approached its twilight in the 1960s, Goldman Sachs stood at a transformative crossroads. For the first time in the firm's history, leadership passed not to another seasoned investment banker, but to the dynamic and intensely focused trader Gus Levy. Levy was a force of nature, a relentless engine of activity immersed entirely in the pulse of the markets. His legendary dedication saw him in the office from dawn until late night, often orchestrating trades with two devoted secretaries who mirrored his unwavering commitment. Under his guidance, the trading division dramatically expanded, becoming a central artery of revenue generation. However, this ambitious scaling simultaneously exposed Goldman Sachs to heightened market volatility and risk, a vulnerability that would soon be tested. The ledger of Goldman Sachs bore the markings of past missteps, evidenced by significant settlements paid to entities like Getty Oil and the University Hill Foundation, financial penances for actions that had fallen short of fiduciary ideals. Then came personal tragedy. Gus Levy suffered a stroke while on a business trip. The news reverberated through the firm like a thunderclap, a stark reminder of human fragility. The shock was particularly profound given Levy's singular focus on business had left the crucial matter of succession planning inexplicably overlooked. The dawn of the 1980s heralded a seismic shift in finance. Readily available capital, deregulation, and an unprecedented surge in mergers and acquisitions created a goldmine for investment banks. Under John Whitehead's disciplined leadership, Goldman Sachs experienced remarkable growth, reporting a staggering $400 million in profits by 1983, a dramatic 60% increase from the previous year. By 1993, the financial engine of Goldman Sachs was generating an astonishing $2.7 billion in profits, largely fueled by its trading operations. As Goldman Sachs strategically expanded its own account trading activities, deploying its own capital in the markets, the firm's once unwavering client-centric focus began to subtly erode. Long-term capital management, a hedge fund built upon Nobel laureate economists and legendary bond trading, operated under the seductive illusion of perfect mathematical models. Initially yielding spectacular 40% returns, it ignited a frenzy among Wall Street's elite. But in late summer 1998, catastrophe struck. Russia, the largest nation in the world, unexpectedly defaulted on its debt. In a single calamitous day, that August, LTCM hemorrhaged a staggering $353 million. Sensing vulnerability, Goldman Sachs swiftly began liquidating its own bond holdings, inadvertently accelerating LTCM's descent. The crisis spiraled until the Federal Reserve orchestrated a $3.5 billion bailout, a move that inadvertently rescued Goldman Sachs from potential contagion. Many demanded answers. Why should American taxpayers underwrite the high-stakes gambles of Wall Street's wealthiest players? Avoid costly finance mistakes. Finance Fiascos Volume 1 Raw Confessions plus mind map PDFs for bite-sized quick review of these videos. Use code CLUE10 for 10% off today only. The 2008 financial cataclysm marked the visible erosion of Goldman Sachs's once sterling reputation. The firm found itself in an ethical quagmire, on one hand, claiming to fulfill sophisticated clients' specific requests as a mere intermediary, while on the other, their trading department operated to generate profit for the firm itself, sometimes through strategies at odds with certain clients' interests. The ensuing years saw Goldman Sachs embroiled in a series of legal and ethical controversies. Yet, despite these reputational scars and regulatory entanglements, the firm demonstrated remarkable resilience. Their profitability endured, and their core client base remained largely unwavering. The key to Goldman Sachs's enduring success appears to lie in exceptional organizational agility, an uncanny ability to identify emerging lucrative trends with foresight and execute strategies with unparalleled efficiency. When inevitable market corrections occur, they exhibit ruthless pragmatism, swiftly cutting losses and positioning themselves for the subsequent rebound. Love them or hate them, Goldman Sachs has outlasted everyone. Who's next to fall? If this story opened your eyes, drop a comment with your thoughts and subscribe for more untold stories of money and power. Thanks for watching.